Hello, Joe Varnadore here from Note School, and I am here today with Mr. Sherman Arnowitz. How are you, Sherman?
I'm doing great, Joe. How are you doing?
I am doing 5 by 5, and just excited to be talking with you today about your company, Keyhole Financial Services, and what you do. And we're everybody's really excited about hearing how your business works. Sherman deals in seconds, right? So you've been buying and selling and managing seconds for 25 plus years, right?
That's correct. That's correct. The genesis of it all, and I tell this a lot, was I graduated college, and my best friend Scott asked to borrow $5,000 for a real estate deal, and I lent him the $5,000 with his promise that I would be paid back within 30 days. And 30 days went by, and 60 and 90 in a year, and I lost a friend, and I lost $5,000. And well, fast forward 15 years, and I get a certified check in the mail for $5,000 along with the phone number. And I call up Scott, and of course, the first thing I say is, "Where's the interest, Scott?" And so he starts telling me this story of that he stumbled on these second mortgages. At the time, it was with GMAC Ditech, and he tells me that these banks, they try to get the borrowers paying on their second mortgage. And after a certain while, they just want to write these loans off the books, and they just want to get rid of them. And so Scott showed me the ropes, and we were in business together for a while, doing very, very well. And at some point, Scott said, "All right, I've taught you all that I could teach you. You're on your own." And at that point, I had to make a decision. Exactly. Thank you. At that point, I had to make a decision. Do I want to do this by myself with my own funds, or do I want to turn it into a business? And I decided to turn it into a business. And under the Keyhole Financial Services name, we created private funds. And it was interesting. It was exciting. At the time, 25 years ago, there weren't a lot of people investing in seconds. And so we got by, and it was like the wild, wild west. And so I would go and find investors. And I remember the first pool of investors that I sat together. One of them was my high school buddy of mine and his lawyer friends. And I remember sitting with him and explaining how the fund was going to work. And it was the first fund that I was raising money for. And sure enough, I sold them. And at the end of the meeting, they said, "Okay, we're going to invest the money in it." So inside, I was saying, "You're crazy. Why are you investing money with me? This is ludicrous." But we did really, really well. And as they say, the rest is history. We've been generating fund after fund with the seconds. And whether it's 15 loans up to 300-400 loans, those are our funds. And we've been doing very well.
Very good. So, I've always, for 30 years, I've invested in firsts, and I've bought a couple of seconds, and I've done pretty well, right? So, and most of our Note School students and the folks that are attending NoteExpo really haven't delved into that. So, if you could tell us, what when you started investing in seconds, obviously many years ago. So, what has changed, from when you started investing, 25 years ago until, let's fast forward to 2020 and beyond. What does that look like today? What's changed in that industry?
Boy, a lot's changed and very little has changed. Yeah. Back then, we were buying second mortgages for anywhere from 30 to 40 cents on the dollar. However, there was tremendous equity. And so all we had to do was call the borrower up and hint at the F word, foreclosure, and they would shake and they would start paying the money. So that was great. Back then, like I said, literally 25 years ago, I could count on my one hand how many investors were investing in second mortgages. And so obviously, over the years, that tiny little secret has gotten out, and more people have obviously come into this market. The good news is that there's still trillions and trillions of dollars of second mortgages out there. And so I think patience is a virtue with that, as well as connections, relationships, et cetera. So a lot is the same. The principles are still the same. Right now, we're still paying 25 to 40 cents on the dollar, but we're not getting the same types of loans. Usually we're getting loans with zero equity at that kind of price, but they may be current with their first mortgage and they've been in the house for 10 plus years and they've got some decent credit scores. So the influx of investors has certainly changed. But the concepts and how great an opportunity seconds still remains the same.
Very good. So, have you, based on the pandemic and all that's been going on, how do you see that affecting the industry, into the future? Are you adjusting? I'm sure you're adjusting your investment to value ratio. We talk a lot about that in the first side. What's your investment versus what it's worth? Are you adjusting that? Are you adjusting yields? What does that look like for you guys?
First off, when people ask me, hey, with this pandemic, you guys are going to get so busy. The reality is that what's going on now with the pandemic, we're not going to see that effect for probably 3 to 5 years from now. And so, the government has put a ban on foreclosing and they're encouraging the forbearances. And so once this pandemic has lifted, now the banks are in play and they're going to start foreclosing. And it takes the banks time to foreclose. And then once they get into the courts, it's going to take time for the courts to process all this. So literally, once the pandemic is lifted, like I said, we're talking 3, 4, 5 years from now. So we kind of have to look into the future with that. But we know it's going to happen. So for us, as sad as it is, it does still become an opportunity. When we're investing now, we're getting in our time machines and we're going back in time and we're looking at those loans that were originated in the early 2000s. And like I said before, there's still trillions and trillions of dollars of these. And so that's what we're playing with now. So it is kind of a time machine lag process, if you will.
And that's what we're telling, people about, non-performing loans, right? Everybody's, oh, they're back. Well, they're not back yet because they haven't gone through that charge-off system, right? So that's going to take some time to get through that. So what qualities do you see to make one, whether you're investing in first or seconds, or you can specifically talk about, like, what kind of qualities do you see that make someone successful in the industry?
Well, first, it's a lot easier, the qualities for people investing in first. It's a very easy, simple play. It's just, here's the money. I'm a millionaire. So I'm not even going to contend with that. Right. Just kidding. The thing I love about seconds, and as much as I know a little bit about first, they have similar concepts, et cetera. I plead ignorant. But the thing I love about seconds is it's fairly easy to get into without a lot of money. You are behind the first mortgage, and so it is riskier. So you do have to have the stomach for that kind of investing. Opposed to first, there's a lot more opportunities in the sense of there's a lot more things you can do with a second than you can with the first. As my understanding with the first borrower, are you going to pay or am I going to foreclose? When we're dealing with seconds, we're dealing with the borrower and we're dealing with the house. And so there's a lot more things. If I'm paying 30 cents on the dollar, there's a lot more thinking outside the box I could do, which leads to opportunities because I've paid for that price. The other neat thing about the second space is you get to wear a lot of hats. And so whether it's here's my financial hat, here's my detective hat, I'm trying to skip trace, here's my psychologist hat, I'm trying to deal with the borrower who hasn't made a payment in umpty-ump years. And so you get to wear a lot of hats. And I'm not saying that you have to be great at all of those hat wearing positions, but that's the fun part, that you do get to wear a lot of hats. And so those are the qualities that you need.
So when you're dealing in seconds, I mean, most of the folks that are with us at NoteExpo have bought first, and they understand that space there. So when you're buying, what does the typical deal look like as far as what does it stack up to look like? The house is worth 250, the seconds they've got 25,000 in equity, and the seconds 25, and the first is 200. What does that kind of look like, Sherman?
It's a different, excuse me, it's a totally different mindset. And so depending where you want to pick from that tree, you want to pick the low hanging fruit, the second mortgage. There's plenty of equity to cover both the first and second mortgage. That's fine. Less risk. You're going to pay a lot more money to buy that note. They are certainly scarcer, harder to find, those types of notes. And the reality is, if I bought the first is 100, the second is 25, that's 125, and the house is worth 250, okay, that's great.
Right.
That's a slam dunk. However, if I'm going to pay 70, 80 cents for that non-performing note, it's still a non-performing second mortgage. And a year from now, the borrower could lose his job and he can't afford to pay the first and he can't afford to pay the second. Yes, there's a little bit of guarantee because of the full equity, but just like the past in 2008, that equity went here to here. So that's one mindset, going after those non-performing loans where there's full equity. Right. What I like to do, how we look at these, is I like to climb a little higher in the tree, and I'm looking for non-performing seconds where they're current with the first mortgage. Equity doesn't matter to me. 97% of the loans we're looking at, they don't have equity. But if I can find a loan, a second mortgage that's current with the first mortgage, they've been in the house 10 plus years, so there's a lot of emotional equity there, and they have a really good, strong FICO score, that tells me the financial temperature of that borrower.
Right.
And so I'm willing to pay between 30 and 40 cents for that type of note. And so when we go after that type of note, we have a stronger hand to approach the borrower with, because we know, why would you risk losing your home? You're current with your first, you've been in the house for this long period, you've got great financial strength. We could maybe refinance your first and second together. We could do a loan modification. So those are really the types of loans that we want to stay focused on when we're looking for loans.
So I've always heard that when you're in the second space, that you never want to buy a second unless they're paying on the first. Does that hold true?
Yeah, I have an academy, Keyhole Academy, and we teach students how to do what you and I have been doing, focusing just on the second mortgage side.
Right.
And one of the things we tell the students is, once we get a tape, a spreadsheet, we format that spreadsheet so it makes sense. We get rid of any columns that we don't need. And now we have the raw data in the format that we want. And now we go through a whole process of elimination. And one of the things that we do is we say, I don't want a second mortgage where the UPB is greater than $50,000. If I'm paying 20, 30 cents on the dollar, I don't want a $15,000, fork out $15,000 on a $50,000 note. If I'm looking at the status of the first, which is ultra important, is probably the most important factor. If I see a note where the borrower is delinquent 60 days, 90 days or greater, eliminate it. Process of elimination,
right,
eliminate it. It's gone. If I see something that's current, if I see something that's delinquent 30, I'll hold on to those. Obviously, I'm not going to pay as much for the 30, but I go through this process of what I'm looking for and how we might start with 50 notes. And after those process of elimination, we narrow that down to maybe 15 notes that we want to bid on.
So you can buy in the first space, you can buy one note at a time. Can your clients, your students, can they buy one note at a time from you?
They can. And whether it's from me, whether it's they buy it from you, if you had seconds, anybody,
Right.
and we make introductions to everybody. When I create a private fund for private investors who don't want to learn, I'm taking advantage of my relationships with banks and hedge funds. And so,
Got it.
being in this for as long as I have developed those relationships. And so whether it's PNC Bank, they're not going to allow me to buy 1 or 5 notes. I've got to buy a whole lot more. And so I'll
Right.
pull my investors and we'll pay $2, $3, $4 million for that large pool of loans.
Right.
Second stage of that is I'm going to look at that large pool of loans and I'm going to pick which loans I want. I'm going to pick which loans I don't want. And those loans I'm going to sell to smaller investors who
Right.
then can buy onesies, twosies, fivesies. So
Gotcha.
there's something for everybody still.
Perfect. So what are some realistic expectations for an investor that's starting out in the space?
The expectations are be patient. When I have students,
I had a feeling you were going to say that.
when I have students that go into this, one of the things I offer is a private mentorship program where after they take my course, the student has a choice. They can participate in my private mentorship. It's they commit to buying 5 mortgage notes. We split the profits 50-50, but we hold their hand every step of the way.
Gotcha.
And I have very eager students. And one of the things that I tell them is, let's take this in increments of 6 months. Because, don't quit your job just yet. I have some students that want this as a career change, and some students like you just want it as supplemental income. And so I want it in 6 months increments. And you'd be surprised, particularly seconds, where it's a little more turbulent than first, that I get a student who's very eager. And all of a sudden, 6 months later, he's like, you know what? This isn't really for me. I didn't think it was going to be risky, or I didn't think that this was going to happen or that was going to happen. And so patience. And you know what? If you like it and you're doing well and this is the opportunity for you, great. Let's take it another 6 months. So those are the expectations. The reality is if you do it right, it is profitable. It's a great opportunity. Last winter, I was down with my wife in Florida. I took my laptop, I took my phone, didn't matter where I was, I conducted business. So that's one of the great things also.
Yeah. Well, that's one of the things we all enjoy about the note space, right? I actually live in Florida, so it's raining. It's been raining down here the last little while, but it's still great, right? So what is really the best advice you could give a new investor or someone that's looking to go into the second space as somebody new to the business completely? And then the second part of that is somebody that's been doing first and they want to expand their base of knowledge.
Great question. Again, I say patience. I say realistic expectations. When we're in the second space, if you're going to buy the right note, if you're going to buy the right note at the right price, if you're going to manage that note accordingly, you can expect to see returns over 20%. And so that's the upside. I always tell my students, you're constantly juggling 3 balls. Where am I going to find the notes? Where am I going to find the money? And where am I going to find the education? I'm constantly learning. And so it's really those expectations. It's the one piece of advice also, it's a very small industry, Joe. And so say what you mean and mean what you say, because once you got that bad X on your back, it's very hard to get rid of that X. And so that's ultra important. For people that are investing in first, like I said, you might be speaking Italian, we're speaking French. There's similarities to that, but it is a different language. And so you do need to relearn certain aspects of investing in seconds, just as if I came over to the first mortgage space, I would also have to do the same.
Right. Well, and Sherman, there's always a learning curve in everything that we do. And that's the exciting thing about the business that we're in, is that there is something new that's happening, day in and day out, and who would have thought, months ago that we would have had what's gone on for the last months.
Yep.
So there is, as we kind of look at that, and I think we, as somebody gets into this, do you, is this with the first, for instance, there are companies out there that service, these loans for us, and there's default servicers. How does that work in the second space? Is there still these same default servicers that are out there working and helping someone work through that process?
Yeah, there is. And because more and more people have got into this space, things happen. And so good things happen, but sadly bad things happen. And I think because of somewhat the bad things happening, the states had come up at some point and said, okay, you need to be licensed. And in some states, you need to be licensed, plus you have to be registered in our state. And so, yeah, that kind of creates a new market for these servicers. And so depending on the state, whether it's self-servicing, whether you want the servicing company to do all of the work for you, including the workouts, sending out the statements, et cetera, or do you want them just to be the servicer of record and you can do the workouts? And that's another alternative also. But yes, they're there. It's kind of hard to digest that you're going to pay $40 for that loan per month to the servicer, not to do the workout, just to send the statements out and collect money. And meanwhile, the borrower is giving you $100 a month. So it's kind of hard sometimes to digest on that. But also the lesson there is, as I mentioned before, you get to wear a lot of different hats. One of the things I emphasize to my students is it's important to know what you're good at, but more important, it's important to know what you're not good at. And so if you're not good speaking with the borrowers, workouts, if there's a language barrier, et cetera, let somebody else do it. Whether my company's doing it, whether a servicer is doing it, know what you're good at, know what you're not good at.
And, you said something just a second ago that really resonated with me, because we hear it, in the training that we do at Note School every day. And we know what those fears are, right? You said it, right? Got to go find the deal. Okay. Got to go find the money. Right. And then I've got to learn how to do it. And, we've learned that right now, we know that there is more money sitting on the sidelines in dry cash than there ever has been. Is that what you're seeing with the folks that you're doing, that you do business with, as well as, in your funds and so on?
Hands down. The secret's out. It's a great alternative investment. It's kept me in my lifestyle. I'm actually on board my 200-foot yacht right now.
Good.
Yeah, it's right here. But yeah, it's there's so much opportunity, Joe. Same with you guys. Yeah. It's just aligning those stars and making sure that you get the proper education, that you're aligning yourself with the proper people in this space, and the rest of it will come. That's
right. So, other than patience, Sherman, any other, best advice that you can give someone that's going to be in this space?
I would say find yourself a mentor or mentors, and align yourself with them and get the real skinny on what this space is about, whether it's first, whether it's seconds. I don't want to hear somebody say you're going to make $1 million the first year. Yeah. I don't want to hear somebody say you're going to lose all your money. Right. I want to hear somebody that's going to tell me what reality is and then let me make my choice from that. So I would probably say, really align yourself with somebody that's got expertise, honor, respect, and align yourself with that person or persons.
Right. Yeah. We always say we just want to know what Monday morning looks like, right? What does the
Mm,
typical day look like? And that's
yeah.
really the realistic expectation there. So as we kind of start to wrap this up, where do you see, and you said this at the beginning of, beginning of the interview here, that, it's not happening today, it's not happening tomorrow, but this will be a buildup over a period of time. So what does 5 years look like in the space?
I feel it's still plenty of opportunity. Certainly, the states have made it somewhat a little difficult to kind of cruise around certain guidelines. If you're going to foreclose, you have to make absolutely certain every T is crossed, every I is dotted. But aside from circumventing what states are going to throw you, the reality is you borrowed money from me and I'd like that money back. And how we're going to do it is up to you.
Right.
And so if we keep that mantra, there's certain investors I know that as soon as they buy a note, they start foreclosing. They don't care. I'm of a different ilk where I may get to that point, but I rather give the borrower opportunity to do that. So where we are 5 years from now, I'm probably your next door neighbor down in Florida. I have a relaxing life, but like you said, also the opportunity in this industry that you can do it. And whether it's 3 hours a day, whether it's full time, it doesn't matter. The opportunity is there and it works and it's profitable. And why stop? And that's ultimately my goal, that I will be, whether it's retired in Florida, traveling, whatever it is, I will continue investing in notes.
But and one of the things, I heard you say there was that, some people, they want to jump in, they want to foreclose immediately. There is a human side to this, right, Sherman?
Absolutely.
And everybody needs at some point in their lives a little bit of a leg up, right? And that's one of the things that I do love about this industry, that you can help others, kind of work through it. What the banks decided they weren't going to, try to fix, that we can do kind of on a one-on-one basis, right? We can kind of affect somebody's lives. And I love that about the industry. And I know that you do too. So,
yeah. One of the things I just want to finish up with is, first of all, the banks created this industry that we're in. So I say thank you to the banks for giving me so far 25 great years. And the other thing I'd say is, when I tell people what we do, they say, oh, you kick people out of their houses. And I say, no, just the opposite. I keep people in their houses, and I'm a believer of karma. And, I want to give these people every opportunity I can give. And like you said, there's nothing better when you're able to work out something that it's fair for me, it's fair for them, and you've done a good thing.
But it has been eye-opening. I've learned a lot, and I know that everybody at NoteExpo has learned a lot as well. Final thoughts and how to get a hold of you and all of that?
Sure. Sherman Arnowitz, keyholefinancial.com. We've got a lot of great things going on, and I wish you the best of luck. And as always, it's great speaking to you, and have a great show.
Thanks so much. And Sherman, we look forward to seeing you again very soon. Thank you for spending time with us today. And we'll just make it through this together, right?
Absolutely.
Thanks.
Enjoy.